we want to see the order come in, whether it's by the phone or email or whatever, written out, processed through the stock system if you're stock, or processed through someone's hours if it's a service business, and then there's an invoice issued and a statement, and then we can see the deposit in the bank account. So we do all that. Then we will actually do a sales analysis, and Paul will run you through what a basic sales analysis should look like. We do the sales analysis so we understand where the money comes from and which customers do it. And then those key customers, we will actually want to talk to them. We will want to understand their buying patterns, and we will ask someone like Bruce, who does quite a bit of audit work for us, to go in and actually dig deep into that particular customer and make sure that they are sales and not all reversed by credits in a different period that we can't see. Does that sort of answer the question on that side?
It does. The other thing I'm interested in is the other thing is, like you talked about 50 or whatever it was, pink toilet seats sitting there.
Yes.
Do you dig into why that happened?
Not necessarily. I mean, there's usually a simple answer. We thought it would be good. We thought 8-year-old girls would want a pink toilet in their bathroom, and it didn't work. Well, hey, we all do that. We buy things and we think that's going to sell, and it doesn't. That's life. But we want to know that it's not something that you made all your profit from last year and you've been feeding up the last of it in this year.
Isn't that part of the sort of test of the management team or the people in the business, that someone just didn't have a brain fart and said, I think we're going to be able to sell 50 toilet seats or 50 pink toilets?
If we only got 1 in 10 of those decisions wrong, we'd be quite happy, to be honest.
And we'd be lying if we said so.
Yeah. That's the nature of business. But what we're actually going to do, any enterprise system, and if yours can't do this, throw it out and get another one, any enterprise system can give you, in a table, date of invoice, invoice number, customer, product or service, cost, revenue, quantity, and so on, in the table. Now that table may be 35,000 lines long, was for LEP 2 years ago, and or it may be 2,000, or it may be 100,000. And then with a pivot table, within half an hour, you can actually see, the hiccup, you can see the anomalies, you can break out the volatility of product groups, you can look at the frequency with which certain customers order or don't order, you can see the underlying trends if they have irregular ordering. And this is information you actually want to be prepared to part with quite early in the process, because a sophisticated buyer, and you can anonymise it. So the first thing you do is, all you do is you look up table, here's the number, here's the customer, put the two together, so they give us the number, not the name of the customer. That's fine, because then when we say, well, why does number 32 do this? You can still answer the question. But that's the kind of thing, if I was you, I would be looking at 3 years before, because that will equip you to answer those questions and probably to solve those problems as well. And that is the kind of thing. And we perhaps haven't separated between what we would ask for before a contract's been signed and afterwards. And that would always be before.
You haven't gone into any great detail about after the contract's signed, presumably there's a period of due diligence and there's a sort of grace period. Do you want to spend a couple of minutes just talking about that? What actually happens?
Due diligence is never long enough. Doesn't matter how long you get, it is never long enough. So usually it's between 2 and 4 weeks for due diligence, whether the company turns over 25 million or it turns over 2 million. That's pretty much the period. So due diligence, we've got a 16, 17-page checklist that we run through, and of course not all questions are relevant to all companies, and it depends if you buy the shares in the entity or you're simply buying the assets of the entity, the questions change. But there's a lot to go through, so again, that's why we use advisors. So we identify the environmental risks as a particular section, and we actually employ someone to do that, to say, okay, are the consents relevant? How many complaints have you actually had? Does your neighbour hate you? Are you the cause of all the seagulls in the neighbourhood? All these sorts of things. We get someone to tell us that. We don't necessarily have time to understand that. And then, as well, what he said, we use Bruce to go in and do some number crunching for us and say, is this turnover real? Are these margins accurate? Is the GP really GP, or is there a certain amount of items that should be above the line in GP that they'll sort of drop below the line? So it changes the dynamic of the profitability.
And so the key thing to remember is that at that point, it's become a very stressful thing. We're spending between $40,000 and $80,000, as well as sacrificing time with our families because it's such a compressed period. So there's an expectation, a lot of other wheels in motion. If a bank is involved, there's stuff to satisfy them. All of a sudden, there's lots of money that has to be put in the right place, and the plans that have to be made afterwards. Staff, customer transitions, supplier transitions, company officer, all that kind of stuff. As well as the fundamental decision of, should we still proceed? Because what you're trying to ascertain is, has the information that's been provided to us, is that true, and is that all there is to need to know? So your purpose is to get to a point where when the contract's signed, actually you've got the best person doing it. Because if that goes wrong twice in a row, then the whole thing has probably gone wrong. And that is going to come down actually to the information that was given before that. And your ability to give that information out is going to come down to your ability to collect it 1 or 2 or 3 years before. Things like the sales data I mentioned. Myles mentioned a compliance register. If we see a compliance register in the information memorandum, we'll go, oh yeah, fantastic. And then we say, oh, you've got any board papers from last year. Yeah, you have to have 2 or 3 board meetings a year. And they've got the same thing in and it's been updated. We put a huge tick in the box for whoever deals with that. So you're going to get a buyer who wants to see the right thing. Because the minute they get into this, they realise that money's on the line, anything that goes wrong is going to make them harder to deal with. And you only need to get it 2 or 3 times wrong. So whilst there is the formal due diligence, which is exactly what they have to actually check, and that is their absolute responsibility, it's the period before that, when they're nibbling at the hook and the broker is trying to get the hook through their lip. In many ways, I would say that's the most important thing to prepare for.
So when I thought the most stressful part of life was getting married, getting divorced, buying a house, I'm clearly wrong.
Sorry, you tended to deal with what we as business owners would do in preparation for talking to yourselves. Looking at it from the other point of view, what are you looking at in terms of payback return on investment? Because there's a criteria that you work to, and obviously depending on how many boxes are ticked, there might be a multiple far greater than if there wasn't, but it still looks a good opportunity. So looking at it from your point of view,
there are a myriad of answers. I mean, I suppose the basics are a multiple of 4 works. So a multiple of 4 means that on a capitalisation of earnings ratio, you're talking 25% return.
right.
But of course, there's an awful lot of risk that goes into that return. So you can put your money in the bank for, God knows what, 3.5 million. You used to be able to put your money in a finance company for 9 or 10. That was the winner. And buying a business actually is still the best return, but of course it comes with the most risk because it's actually up to you to go and make it happen. So a 4 multiple is probably where we start. So if you've got EBIT of $1 million, we would start with a number of 4 million in our minds, and then we would look at the quality of the information, the quality of the people, and the potential of the market you were in, and decide whether that number should go up and down. Did we bring the checklist?
It was on the computer. But we have about 20 sub-questions within that. So we start with how reliable is that revenue. So I think in the rubbish game, the multiples are up around 5 or 6 because people contracted for years. The margins were skinnier as a result, so the overall answer was probably the same. If you come down to something that is essentially more of a jobbing work, you're really starting off with something like 3 because your certainty of income drops to maybe 60%. And that's your big scare, is that you'll take something over and 2 months later the order books will be emptier because there are things you don't know. So that's the sort of scale is where you start from. And then we've got sections on the customers, how healthy are they financially, how broad are they spread, how much do they need you?
So is the sector that your customer operates in growing?
Yep.
Or is that sector shrinking?
We've got one for the suppliers, 5 or 6 of them. How strong are the relationships? How much power do you have in the relationship? Are they evolving what their products are? We have one that deals with the staff. How much level of technical skill, how much level of commercial skill is needed to operate the business? And lastly, what ability does the business have to evolve? So a lot of people will present a specialised business and talk about opportunity, but if they're the only person who knows it that's there, that ability doesn't exist from our perspective. It gets a minus, not a plus. And in our case, it'll make us look stupid.
Yeah, so there's real risk.
Is there or can there be a phase in, phase out period? I mean, you know, when you were talking about enviro waste, you were there for 3 months.
I did a 90-day handover, but I already had their money. Now there is, of course, more than one way to pay for a business. So you can pay, the preferred answer is 100% on the day, thank you very much, shake hands, walk away. Most people ask for a handover period or at least some type of vendor assistance. Whether that is paid or unpaid is actually up to negotiation. But to be perfectly honest, if you're a seller and you think, okay, I'm going to get X million for my business and it's going to cost me 90 days of my life to hang around and make sure they're happy, I wouldn't put a price on it, because use it as a negotiation bargain, you can give that chip away. But there's delayed settlement, there's vendor finance, there's all sorts of ways you can get that buyer across the line. But you've got to recognise the increased risk to you as a seller around what you're selling. I have to say, from a buyer's point of view, if a vendor is willing to leave money in that business, it makes us believe that they believe in their business to the nth degree. Because if they didn't believe in it, they wouldn't put that money at risk.